So I think I'd like to. So there's going to be a little bit of a. Can you guys hear me clearly? Given that somebody is speaking there, it's fine. Okay. Okay, super. So I want to just understand the audience before we move forward and see how relevant we can make this conversation to you. So I just want to very quickly, there are just few of us here, just pass on the mic, and just if you could say your name and what your profession is, it'll just help me navigate this better.
My name is Shaji Banjuran. I am from Cochin. I have a startup unit. We supply into food packing materials.
So you have a startup with food packing
yeah.
materials. Super, super, super.
My name is Santosh from Kannur, and I run a biodegradable paper cup unit.
Biodegradable?
Paper cup unit.
Okay, okay, understood.
Hi Roma ma'am. So myself Mohammed Anas. Basically we are from Trivandrum and Kollam. He's a CEO of the company and I'm GM of the company. So basically we are running education related company.
Education related
professional
company
training.
and Trivandrum based.
Trivandrum and Kollam.
Okay, understood. Okay.
Hi ma'am, I'm a third year computer science student in John Cox Memorial CSI Institute of Technology, and I'm doing my freelance web designing works. And now I have a startup idea, and I came here to
You're
know
an
more
aspiring
about,
entrepreneur.
Yeah, aspiring entrepreneur.
Awesome, awesome,
Thank
awesome, awesome. Just pass it this way.
Hi ma'am, my name is Faith Shago Abraham. I am CEO of a blockchain startup in Kerala. I'm from Changanashiri, Kottayam.
Tell me the sector again.
Blockchain.
Oh wow, very nice. Huh.
I'm Mohammad Shahri, coming from Malappuram. I'm a freelance web developer.
Freelance web developer from Mysore.
Malappuram.
Okay.
Hi, I am Amjad, CEO of Play Sports. It's a marketplace for sports facilities.
Oh really? And which jurisdiction?
Pan India.
It's in Pan India.
Yeah,
okay.
we started from Kerala and we are market leaders in Kerala and all the northeast states.
Oh wow.
In around 10 states, we are the market leaders.
So one
and we
can
have the
go to
Pan
your
India presence.
website and then, or your app and book a sports facility.
Yeah, just like you do Make My Trip for you use Make My Trip for hotels, you can use Play Sports for booking sports grounds.
Ah, very nice. Interesting. And you're looking to raise funds? Yeah, okay, understood.
Hi, my name is Alina and I'm a senior manager at Ace Money. We are into fintech.
Correct.
I'm from Kochi.
And where are you based out of? Kochi.
Kochi.
Oh, very nice. Ah.
Hi, my name is Shahid. I'm the founder CEO of this company called Codofin. It's an edtech startup which is all about teaching young students how to use tech skills like coding as a life skills add-on.
Oh.
Not with the intention of making them software engineers, because we believe everyone will have technology, will have a major role for everyone. So we thought we'll teach them young. So
Yeah. In fact, we've worked with a few companies who've thought of this, and one is realizing that it's going to probably be a life skill.
That's what we thought actually.
Yeah.
We don't want it as a technology skill, it's as a life skill tool. That's
Fair
plan.
enough. Fair
All
enough.
right.
Fair
Thank you.
enough.
Yes.
Okay. Just very quickly, if we can get.
Yeah, my name is Ajit Thomas. I'm from Kannur, and we have a startup called Finext Innovation.
Okay. Okay.
Hi, my name is Shiva Prasad. I'm founder of EdTech company. It's an arts learning platform. It's called Natya. Thank you.
From Kochi?
No, from Calicut.
From Calicut. Okay.
Hi, I'm Akhil Krishna. I'm also from Calicut. We have a SaaS CRM for SMEs.
Okay.
Hi, I am Jassim. I am from Kasaragod. I work as business manager and Central Plantation Research Institute.
Somebody?
Central Plantation Research Institute.
Okay. Okay.
Hi, I am Manoj from Thrissur. Our company is called Mirror BI. B stands for Financial Literacy, Business Analyst Platform.
Okay. And so lots of founders here. That's good, right? Because I wanted to make sure that the topic is relevant. So how many of you in your entrepreneurial journey, or people who are still in college and are looking to be entrepreneurs, are fascinated about fundraising, right? Given by the global climate. And how many of you have ever raised capital? I'm guessing none of you have raised external capital till now? Huh? No. You've raised external capital? If you can give her the mic.
We have raised seed funds and all, ma'am.
Okay. You raised seed funds from whom?
From KSU.
Okay. Very nice, very nice, very nice. Okay. So I think first let me do this, that let me speak about... Hello? Yeah, okay. Let me just run through what a term sheet is, because that's the core of the session today, about external fundraise, how it works, how do rights work, etc. And then what we'll do is that I will, given that most of you are startups, we'll open the floor for Q&As, because I'm sure you have other doubts also beyond term sheet, right? If there's any way that we can help you, that'll be awesome, right? So let's first, address the topic of the masterclass, right? In terms of what is a term sheet. Does anybody know what is a term sheet here? The mic is there.
Yeah, basically the term sheets, already you asked about anyone, capital related, you invested somewhere.
Yeah.
So the term sheet stated that for all the terms and conditions, we have to state it in the sheet for the mutual. It's a collaboration. It's like a collaboration. So all the revenue and the income and the shares and rules and regulations, how to act, when to act, where to act.
Yeah.
So I think in my awareness, that's called term sheet, right?
Yeah. It's a principal agreement between, from the fundraise angle, between the investor and the company. The parties to a term sheet are the investors, the company, and the founders. Okay, you don't get all your other shareholders to sign the term sheet typically, just for ease of convenience. Okay, now what's important is that the term sheet is, look at it like all of you just compare it to a memorandum of understanding. It's a shorter version of a principal agreement, so it can range it can range anywhere from 1 to 10 pages typically. But what it does is it puts all the principles of what the investor seeks in terms of proposed transaction, the instrument, the rights that they're seeking, the obligations that they want to put on the promoters at a macro level out there, right? From a perspective of a promoter, I think most promoters are most wary about something called the pre-money valuation, which is the valuation at which the investor will invest in your company. Okay, let me break some of this jargon out for you. So whenever you go for fundraise, right, let's take simple examples here so that you understand this better. So if you're raising 10 crores, right, and the investor asks you for 10% stake in the company, right, anybody knows what your valuation of your company is? Just give them a mic, no? They can pass it around, huh? Yeah, here.
Is it based on the capital invested, right?
Yes. So the investor is telling you, I am going to invest 1 crore in your company and I'm going to take 10% of your company. What is the value of your company?
10%?
For 1 crore rupees.
Okay. No, I don't know. No. Anybody? 10 CR.
10 CR.
10 CR.
It's simple unitary method. Okay. So, when you talk about valuations for startups, a lot of people ask us that when we decide the valuation in our term sheet, how do we do it? How do we know what is our value? So I want to break that myth once, guys. There is no way that you can come up with a proper formula to derive what is the valuation of your company, right? Typically in early stages of business, it is more to do with what the negotiation is between the investor and your company, right? And the valuation is on the basis, it's on the whole on variety of things. Founder's pedigree, what has the founder done before, the idea, the potential of the idea, the scalability of the idea, if you hold patents to that business, so your goodwill attached to the business, right? So a valuation is holistically a broader concept of what is the value at which the investor will come in your company, but you as a founder cannot sit down and do some maths to find out. So don't invest your time in that, right? How you will typically realize your value is when you speak to investors, you speak about your business, you tell them, this is what I'm building, this is what the market is, this is the jurisdictions I'm looking at. The investor typically comes up with, like I said, some value. So here we've taken the example of 1 crore for 10%, which basically means the valuation of your business is 10 crores. And what is the pre-money valuation of your business? It's 10 minus 1. So it's 9 crores. Got it? It's as simple as that, right? Now, how this works is that once you have arrived at this number with the investor, typically, the filings that you need to meet, you will get to a valuer and you will tell the valuer that this is the number that me and my investor have agreed upon, and the valuer will then see, depending on your cash flows, your future projections, future revenue potential, scalability of the business model, will draw it down to a 9 crore figure, right? So I think valuation is something that most entrepreneurs are very, very sensitive about, and they want to know what is the right value for my company, what is the right value for what I'm building, right? And I think the answer to that is that the only way you can see some semblance is to do some comparative analysis, right? You're building, for example, a SaaS company, right? At a certain stage, if you can look at what are the other SaaS companies that got funded, what stage were they, what was the pedigree of the founder, give or take, right? We see companies in their initial stages raise money at 10 crores pre-money also, 20 also, 30 also, 40 also, 100 also, right? So there is no right maths for it. So don't look for the right maths, okay? This will be typically a negotiation between the investor and you, right? Now, what all does the term sheet have other than valuation? Term sheet is a non-binding expression of interest. It becomes binding when you sign the detailed agreement, which is the shareholders agreement. It contains broad contours, so it doesn't go into detail. It speaks over all, what is the transaction, etc. It is non-binding other than certain clauses like expenses, dispute resolution, confidentiality, right? You can't take a term sheet and inform someone else about it in the market, right? That's why they're saying that this is binding. It forms the basis of the negotiation for the shareholders agreement, which is the longer form, okay? So if you were to compare it to a lease, guys, when you sign the MOU, that's the term sheet. When you sign the lease deed, that's the shareholders agreement, right? The MOU will only state the important things, and then this will eventually become the foundation for your shareholders agreement with more mechanism, rights, details, etc. Okay, now what are the key elements of the term sheet? It's not clear here, so we'll ask someone to fix it. Can you fix it? No? Okay, okay. So I'll explain it to you anyway. So what is the proposed transaction? Proposed transaction in a term sheet clause just means how much are they investing? What is the instrument that they want? Do you guys know what are instruments? Does anybody know what is an instrument that an investor takes in your company when they invest? So let me spend 2 minutes on that. See, typically an investor invests, equity investors invest for shares in your company, right? What kind of shares? There are two kinds of shares. There's equity shares and there's preference shares. Venture capital investors typically take preference shares, okay? They don't take equity shares. Why? Because the law has two benefits for preference shares. One, that it sits on top of equity shares in case of any change of control or any exit scenario. So investors have to be paid up first, right? Venture investors don't ask for a guarantee on the investment, right? They're not saying that you have to return the money. It's not a loan, but they take a priority payout. So if there is money coming to the company, if there is exit available, the investor has to be paid out first, right? So preference shares is probably the most common instrument that all of you should know who want to raise capital. It's called compulsory convertible preference share. It is 90% of the deals in India and globally are done with this instrument, right? Now, what are the other instruments available? If I were to take 1 minute on that, there are debentures, there are convertible notes, there are equity shares, of course, there are warrants, right? But to not overcomplicate it for you guys, most of that is used when the transaction is built in a way that it's a bridge round between two rounds, or the valuation is not fixed, so the investor has built a formula, right? But for today's class, just know that when an investor invests in your company, they typically take shares. Shares are of two kinds, equity and preference. Most investors prefer preference shares. That's a good summary for today's class, right? Now let's move on. What else does this term sheet say? Term sheet very briefly says what are the rights that the investor wants in your company, right? When financial investors invest, they're not asking for a guaranteed return, but they have to oversee how the investment is, utilized, what the founder is going to do, how is he going to scale. So what do? They take rights in your company. So you no longer are the sole person who's deciding how this company is headed, right? And I will go into what are the kind of rights that they take, right? But overall, just think this, that look at it from a very simple perspective. If one of you were to invest in any company, right? What are the kind of rights would you like? Anybody who has a mic, pass it around.
Board seat.
You would want a board seat in that company. Okay, what else? Pass it around, give it to... Let's get one person of each row to say something that they'd like if they had invested in a company. Just give it to them.
Yeah, basically, anyway, financial control access, not to...
So you'd like audit, inspection rights,
yes,
right? Some information rights, what are the financials,
yes,
where's the money being utilized?
Yes, and the good will be implement good policies and procedures to get it organized.
Yeah. So you'd like it to be organized, you'd like to have information about financials and have the right to audit it, right? Let's move it on. Who else can think of something? What else would you want?
Get maximum shares.
You want to get maximum shares. That's not good for your startup. I think he wanted to answer.
Yeah, I would give all the control to the founder. I just don't need, but just need the preferential exit. Whenever an exit option comes, I just need a good exit.
Okay, think about it. Exit. Now think one more time. When I am investing in your company, do I want you to stay as a promoter? I wouldn't want you to leave, correct?
Yes.
Right? So what is the right that I would like to keep in the company so that you can't leave easily? I can't invest the money and then I can't have you leave, right? What would the investor expect?
Yeah, the founders has to be the...
He seems to have done this class already. He's saying vesting. You have investors? Okay. So you would want to vest the shares of the founders because you don't want him to leave easily. What else would you want? You would want to probably lock his shares so that he can't exit easily, right? Right? What else would you want? If the founder is selling, you would also want to exit along with the founder, right? See, startups are nothing but founders early on, right? If the founder is leaving, there's no value. It is not a Paytm or a company that is already scaled which can survive without the founder. So if the founder is leaving, I want to exit, right? So when I go through this, you will actually realize that so many of these rights are just common sense. You would also want these rights, right? But to what extent should you give them? What should you push back against is what we'll concentrate in this class, right? So there are promoter obligations. So what I spoke about right now, lock-in, if you exit, you have to give an exit to the promoter. Those are promoter obligations in the term sheet, okay? Miscellaneous, we'll skip, right? So those are just legal jargons that have to be there. We already discussed some of this, right? We'll go to investor rights, right? What are the kind of rights? So you said board seat. There is something called a preemptive right. I'll explain what that is. There is something called veto rights, right? I'll explain what that is. There is ROFO, there's tag, there's exit, there's information, there is economic right, right? If you're an angel investor, typically you should not have all the rights, correct? Yeah? Because who are angels? You guys are I believe Kerala also has an angel network. Do you guys know what an angel is? What's the difference between the two? Angel investor, lead investor, our team has written there. What is the difference? Mike, please, guys.
Angel investors invest out of their money. Like they invest their money.
They invest their money, yes.
Single person investing.
Okay, yes.
They are called...
What else is an angel? If I were to decode it very simply. They take the mic.
They won't take part in any managerial kind of
They won't take part typically in management, right?
They just invest money and...
They just invest money. They are literally like angels. They just invest money and they don't want any rights.
They provide strategies, business
They want to provide
connections,
strategy.
networking.
So, yeah, correct. So, let me make two broad categories of investors for you guys, right? Category one is angels, right? Angels are typically individuals. They are, they are HNIs, right? And they are basically people who want to fund companies and be a part of innovation economy, right? And they basically invest in early stages of the business. So angels typically will invest in your first, second, third round of the business, okay? They will not typically come in a scaled company. So when a company goes through multiple rounds of funding beyond Series A, typically an angel will never invest in a company, right? Because they are individuals, right? What else? While we are speaking about investor classes, I think it's important for you guys to know who all invest in a startup. We're talking about fundraise, term sheet, but who invests in a startup, right? There's an angel, which we spoke about. Then there's an angel network, right? So you alone are an angel. If all of you start investing together, right, then it's a network. It's as simple as that. It's a pool of people who invest together, right? So when you hear Mumbai Angels invested in this, Chennai Angels invested in this, it basically means that a group of HNIs have collectively made an investment decision to invest in a particular company, right? And one or two people of that group will take a slightly more active role with the company to negotiate rights, to maybe be on the board seat as a representative, right? So if I make this an angel class and make you, sir, the board director and the person who's negotiating, then you become my lead angel and everybody else becomes my angel in my cap table. All of you then directly invest in my company. So all of you have direct stakes in my company. So if I take investment from all of you, then I have, say, ballpark 20 shareholders in my company, right? What next? What comes next? Family offices, right? It's becoming a very interesting class of investors in the country. Family offices are basically families which have wealth, right? Maybe from conventional industries, right? So the popular family offices of today are the Munjal family office, Dabur family office, right? Big industrialists, small industrialists, people who may have made their primary wealth in some other sector but want to now support innovation and have a portfolio of assets. And trust me on this, just as my intro, I run one of the most active law firms in the country that works with startups and investors. We actually, for the last 3 years, have done the maximum number of deals in the country. It is becoming more and more common by the day for people to look at startups as a not just an option, but a compulsory asset class in their portfolio. So more and more family offices are coming up, right? It's not just in metros now, it's not just the big family offices, but family office is basically a family's wealth that they pool in startups, right? What is the next thing? Then you will hear of, anybody's heard of AngelList, Let's Venture? Have you guys heard of these terms? Yeah? You know what are these? They are platforms, okay? So now we are graduating from a network to a platform. What does the platform do? The platform is using technology, so it's one step smarter, right? Here, sir was going and coordinating with everyone. Now, Let's Venture comes or AngelList comes and says, sir, don't waste your physical time coordinating with everyone. You come on my platform, I'll automate the rest of the things for you. So sir does not now have to call sir and say, oh, you have to wire money, this is happening, that is happening. AngelList takes the entire flow of events in their control using technology. All sir has to do is, plug and play, sign an agreement with AngelList, and then AngelList manages the entire process for you, right? So AngelList, Let's Venture are now, SEBI registered funds that pool assets from a group of individuals and then invest in the startup, okay? Now, why does this seem more helpful to you guys? How is an AngelList better than having 20 shareholders? Anybody?
Cap table will be...
Yes, because your cap table is important, right? One of the things as a startup founder you need to know is that your cap table should not get overcomplicated by having multiple people. It's a huge logistical nightmare, later on in your career, once you have scaled the business to coordinate with so many individuals. So what the platforms do is they give you one line entry on your cap table. So all of you invested through one platform and are one shareholder on the cap table. And at the back end, the maths remains the same. You all have your pro rata allocation, right? The difference between the network and individual allocation, if you look at it purely financially, is that the platform charges, right? So a lot of angels don't prefer to invest through a platform because there is a 22, they call it, 2% management fee and 20% carry on the investment that you make through the platform, right? So networks that don't want to pay this sum of money to another platform, they continue to operate individually, right? Now, who comes? The most aspirational investor for every founder is a venture capitalist, right? So the venture capitalist here my team refers to as the lead investor, right? What is a venture capitalist? Now, venture capitalists are seasoned professionals who are in the primary business of investment. They don't do anything else. They're not a family office. They're not an angel. They don't have any other day job or business, right? Their business is to invest in startups. They raise money from a group of people, right, which are called their limited partners, right? They promise them a certain return. They spend 24 hours all day, all night, right, to find the most interesting companies, invest in those companies, scale those companies, and then exit, right? And give their investors a return. What you guys are doing on the ground, the VC is doing on top. The VC is also raising money, right? And then downstream, they're investing money in your company, right? Now, VCs are professional investors, by which I mean that VCs actually, invest a lot of time in the growth of the business, into opening doors for you, because their success runs on you. Right? So while you're raising money from angels, somebody said here that they don't really interfere, angels, you said, right? That the angels don't really interfere. So angels, family offices, unless it's a strategic family acquisition kind of a thing, but angels, family offices, networks typically don't want a lot of rights. Right? Why? Because they also have other things to do. They don't, their main core business is not to invest in companies and scale them. Right? But venture capitalists, core business is that, right? So they typically seek a lot more rights from the length of your term sheet, right? So one key fundamental or takeaway, if I were to give you from what I have said till now, is that you should know what are the rights there in a term sheet, right? But you should also know who to give it to, right? For example, you guys said that I should have a board seat if I'm investing. But if I raise money from 20 people, should I give board seat to 20 people? Answer is no, right? You said I want information rights. So if I raise money from 20 people, should I give information to everyone? No? You have to give. Yeah, that's a trick question. Some rights you have to give, right? Why will somebody invest in your company if you won't tell them anything? Think about it. Will you invest in a company I don't tell you anything? No, right? But information rights doesn't interfere with your day-to-day operations. That's the difference. Board seat interferes with your day-to-day operation. So when you think about, what are the rights that are there, plus what are the rights that I should give, you should be putting a filter of who am I giving it to, what will be the relevance of that right, correct? So that's what we're trying to say, right? Economic rights, by which I mean commercial rights, have to be given to all classes of investors, because by the end of it, there are financial investors. However, the lead investor, why we didn't write a VC there is because lead investor could be a family office. Lead investor could be an angel network. It's not like they can't be. But if somebody is leading, then they will play a more active role with your company and be more involved, and therefore will need more rights. Okay? Let's move on. Okay, we come to our favorite topic, board seat, right? So, I'll tell you surprisingly, most people think in the startup ecosystem that investors all want board seat. I don't want to give board seats. It's a common founder thing that why, so many board seats are being requested. How do I go about it, etc. You'll be surprised actually that, the growing trend is people take board seats, they don't exercise it. Most of the early stage businesses will realize that even though the investor may have the right to appoint a director, they typically don't also want to be on the board and have fiduciary and other, legal obligations on them till your company goes of a certain stage, right? But when somebody asks you for a board seat, what should you know as a founder, right? you should know that, how many board seats to give. If I were to tell you, let's take a practical example. So I have, let's take a round size of $1 million, okay? 500K a venture capitalist is putting in, 100K is coming from angels, right? 200K a network is putting in, 200K a family office is putting in, right? Simple. 500K VC, 100 angel, 200 family office and networks. What are the rights we'll give whom? Mike. Let's speak about the angel. What are the rights you will give the angel? Okay, let's speak, actually, we'll stick to board seat. Let's run this test through all our rights. And all of you will know what to ask in a term sheet, right? So, will you give, let's do the maths, right? Will you give the board seat to the angel?
No.
No. Will you give the board seat to the family office?
No.
Will you give the board seat to the network?
No.
Will you give the board seat to the VC?
Yes.
And why?
More investment there.
More investment, going to play a more active role, will be leading the investment. You will try to not give the board seat to anyone. You may have to because they are not agreeing, but that should be your starting point, right?
Yes.
Okay. Now we've said why preferable to have odd number of board directors. Anybody understands why we've said that? Because board में voting होती है, right? One person, one vote. So if you have even number of people, how will you come to any conclusion? You won't be able to come to any conclusion. That's why, okay? Majority voting power should be with the promoter, right? You should never have a board where, say, you're a single founder. Anybody here is a single founder? You're a single founder. You want to raise money. You go to an investor. There are 3 investors. The same 5 investors are coming. They take 2 board seats. You are left alone on the board, right? So that means none of your thoughts really matter, because you at least need to get the buy-in of one more person, right? Also, you want to make sure that you're a part of all board meetings, etc., right? So quorum rights for single founders is very important, right? Preferable for promoters to have a right to nominate director in case of several institutional investors have a board seat, right? If, for example, you land up in this kind of a situation, which I spoke about, where your sisters are insisting that I need 2 directors, this investment will not go through, then you should be asking for another board seat as well, right? To have at least an equal position, right? Now, this will not always be the case. Typically, when you see boards as they grow up, like as the company scale, then, founders may have 2 board seats, investors may have 3, 4, but, by then the founders negotiate something called founder AVM rights, which basically means that the founder will have to be, but that is only given once you've scaled. You will not get it early on. So I'll not spend time on that, okay? Fall away threshold. So sir, I invested in the company where you gave me a board seat as a VC when I had 20% in your company. Should I have this right for a lifetime? Yeah? Even when I'm a 2% shareholder in your company, I should be on your board? Yes, so simple logic, right? When you are a material major investor in the company, then it makes sense for you to have some rights. But when you are not a major investor, you cannot continue to have any right for life. Just always remember, right? Whatever rights you give, you should not be giving them for life, right? These are very difficult things to negotiate unless, you have bargaining position. So you may not be able to get everything at your first term sheet level, right? Be also accepting of that. But my job is to make you aware of what the world is out there so that you're more conscious, right, when you're negotiating. Ask the right questions. If it comes through, great. If it doesn't, you'll have to negotiate it in the next round. Okay, now let's move on. Now we'll run this test on someone else, right? So you are my next, okay? So observer seat. VC, will you give the observer seat?
No, yes.
Yes. Does anybody know what's an observer? But let's go back 1 second. Anybody knows what's an observer? Okay. Observer is a person who is literally an observer, okay? So he comes to your board seat, he doesn't have voting powers, he can observe the meeting, he gets notices, agendas, everything, minutes of the meetings, but he doesn't play an active role. So what is the point of having somebody who's only observing and not doing anything? What do you think? Why do people appoint observers? It's not for free lunch at board meetings.
For getting information.
Huh?
And if everything is going well.
What? You don't have to obey him. He doesn't have any voting power. Because you want to keep in touch with what's happening in the company, right? So in the same example where you said, I will not give that family office a director seat, right? And the family office really wants a director seat. Your next best thing that you can give him is observer seat. So you tell him, fine, you really want something. You come, be a part of my board, but you're not going to make an active, role in terms of voting rights because there is already a lead investor who's taking care of that role. Got it? Simple as that. So this person doesn't vote in your board meetings, he only attends it. It's a right to extend to your second or third largest investor, right? If they can be okay with not having a board seat and having this right, it solves for a lot of issues for you at the board level. Okay? Makes sense? Will you give angels, by the way? Angel networks, board seats?
If the other second or third invest.
Yeah. Then you will give them a board seat.
No, observer seat.
Observer seat. Yeah. Now, all that, so if you were to take the example that we took in the beginning, you can't also have 4 observers. Can you have 4 observers?
So what is the problem with 4 observers?
The problem is that, one too many. People's opinion matters. Whether I have a voting right or not, your board meeting is supposed to work at a certain kind of efficiency. If you call 30 people for your board meeting and everybody has a point of view, decision making will become that much slower. So you don't want many observers. Even an observer, you want to give it to maybe second guy, third guy, at max. You can't give it to everyone. Just know that. Okay? Let's move on. Veto rights. Anybody knows what are veto rights? Let's give this mic to sir. Yeah. To you. Yeah. What do you know what are veto rights? I'll explain. A veto rights are rights where the investor can say nothing doing, you can't do it. Okay? So you as a promoter are very interested by some startup, you want to buy it. You go to the board, investor says no, you can't do it. Yeah? You really think this investor, should invest in your company. But investor feels pedigree is not right, valuation is not right, maybe you should wait it out, you can't raise that money. Investors basically make you agree on a list of X number of items where they feel that, these are key decisions of a company, right? For example, you raise funds and the first offer that you get for an exit, you want to take it. Your investor may say no. He may say build, right? But the investor exercises control in the company through something called veto rights, which is basically like everybody knows how, the global veto rights work, that one country says no and you can't go forward. It's exactly that. You propose, investor says yes or no on those items. Now, what are those items? We'll show you in the next slide, I think, right? It's too small to read, guys, but I'll tell you all the important decisions of your business. Annual business plan, annual budgets, your exit, issuance of shares to a new investor, dividend distribution, giving someone a very high salary, right? So investor exercises control in the company. Once you've given money, there's not much you can do. What can you do? You can draw some boundary within which they have to operate so that you can get an optimum result. It's that, right? Now, I want to come to you, sir. Who will you give veto rights to in our example?
VC.
To the VC. And who else will you give it to?
Some powers to the angel investors also.
You will give some powers to the angel investors. Okay. Anybody else? Or let's reason it with you. So if you give it to 20 angel investors, each one of them tell you what to do, what will you do?
Only one representative.
You will give it to one representative. Right? That's not your best bet, but if in case they don't agree, then you will offer them some rights, right? That's the way you're approaching this. Ideally, your veto right should stay with 1, 2, maximum 3 people, especially at the stage that the example that we've taken, you should give it to only one person, right? When you have to share veto rights is, now we do this round, then some other investor comes and puts $5 million in your company. Now you can't tell the $5 million guy you will not give him veto rights. You can't take it away from your lead investor because he's still sitting at 15% in your company. So you'll end up sharing the right, right? But typically in a single round, you should not be giving this to multiple people. You should know that veto rights are like diamonds. You do not want to be distributing them for free to anyone. Right? So who should get a veto right? If we were to draw a broader principle, veto right should be given to people who are actively participating in decision, who have invested the maximum amount of money in your company, hold the maximum amount of stake in your company. It is not meant for minority investors. Yeah, simple? Okay, we'll move on to preemptive right. Now this is legal jargon, but simply said, I invest in a company and that company starts doing well. What do I want to do? Let's pass on the mic to someone. So you invest in a company and the company starts doing well. What would you like to do? Yeah, oh, there is another session. Yeah. You'd want to invest again in the company, right? Because you are like, see, how do startups work? What is the fertility rate of startups, guys?
So guys, next we have a panel discussion on the topic.
It's a lot, right? So you may not invest in the right companies always. When you invest in the right companies, you want to invest again. That's preemptive right, okay? Now, who will you give the preemptive right to?
We have Victoria
To the lead investor.
Yeah, preemptive right is the right to reinvest in a company that you've already invested to maintain your shareholding percentage. So if I invested in your company, I hold 20%. When you raise money next time, I will get diluted, correct? So I will invest more money to stay at 20%. That's the right, okay? You will again give preemptive rights. See, you may have to give preemptive rights to everyone in the first few stages of your business, but in your mind you should know that eventually I want to give this right to only people who matter, whose money I want to keep taking, simply put. Yeah? Yeah.
So what if an investor is already there in a company and they have the veto rights, and we are raising another round and we got a better valuation and we are happy, as founders we are happy. So they want, as they have the preemptive right, they want to invest in a lower valuation for that.
Okay.
Can we say no?
Yeah. So, the thing is, you're right. It can create a conflict, right? And the investor in your cap table definitely has the right to say no to the investment, but they don't. Why?
Better valuation for them?
Better valuation means that they can show their investors that the company has gone forward. I'm not only infusing money in this company at lower valuation. See, the VC wins when you win. So even though there is a conflict, they will always work towards making things better for you, right? And VC is an institution, so it is not one person's arbitrary decision. But if you are raising money from an individual angel, that person could take that kind of a view, right? Or you could, or if you're doing a strategic deal, that person could take that kind of a view that it should be low. But VCs don't work like that, yeah? Okay. I think difference between ROFO and ROFR is too much complication, but necessarily I'll tell you this, because investors want to invest in companies and increase their stake when they are doing well. Like I said, that they want the preemptive right. If the founder is selling, they typically want the right to buy their shares. Okay, that's called the ROFR right. Yeah.
Ma'am, after how much period of time the investors reinvest?
No, they don't reinvest as a matter of practice.
Is there any specific period of time that
they'll reinvest in your company? No. There's no specific period of time within which they'll reinvest in your company. It really depends on whether your company is doing well, not doing well. Typically a fundraise is planned by the board, right? It also depends on how much capital you have. So typically people start raising funds anywhere between 6 to 8 months before they will run out of capital. Right? If nobody will invest in your company, your existing investor may come and invest in the business. But they don't have any timeline unless that deal has been negotiated prior to investment. That I will invest this month and then after 12 months. It doesn't happen like that. Okay? Okay. What is a tag along right? This is a right that I was explaining to our friend there. Which was basically the right to exit along with the founder. If the founder is selling their shares, the investors also need to sell their shares. Okay? The founder needs to ensure that the investor also gets an exit alongside the founder. So if the founder is selling 5% shares, he also needs to sell investors 5% shares. This is to ensure that the investor doesn't land up in a business where he had invested because of the founder, but the founder is left, right? Who will you give tag-along rights to? You will give tag-along rights to everyone, not to major investors, because it is the basic premise on which I invested in your company, right? I'm not asking to interfere with your business. I'm not giving you anything. But if you are leaving the company, take me with you. It's a very common ask, yeah? Information rights, we all understand this, right? So you will have to give some or the other form of information rights to everyone. You may not have to give every right to the angels, but like you said in the beginning, you will give all rights to the lead investor and some rights to all other people. Yeah? Inspection rights, again we spoke about this, right? If if you've invested in a company and you feel something is going wrong, this is a right that investors take. Again, this is a right which is self-explanatory, but you don't want to give it to everyone. If you, over time, raise money from 10 or 20 investors, you don't want every investor to have an inspection right. Inspection right should be with the lead investors. What are exit rights? Anybody knows? Exit rights are the rights to basically ask the promoter to get you an exit. See, most investors have a exit mind frame in their head, right? So they think that I want to be in this business for 3 years and exit. I want to be in this business for 5 years and exit. I want to be in this business for 7 years and exit, right? So it's the right where the investor can force the founder to find an exit for him, right? Typically, funds keep an exit period of 5 years. 5 years is the most standard exit period in the entire ecosystem, right? Some of the things investors expect, they expect that they should be able to freely transfer. Don't bother so much. I'll get the Kerala mission to send this to you guys. I've sent it to them. Tell them to email it to all the participants. I think it will be helpful to you guys. Okay? What is liquidation preference? We discussed this also. It's the priority to get out. That's why they take preferred instruments. They want to take an instrument that will allow them to get out before the promoters, and the right that allows them to do that is the liquidation preference right. Okay? Types of liquidation preference is a very complicated topic and is not required for our current discussion. But what you need to know is that non-participatory 1x liquidation preference is the market norm, right? Write this down somewhere if you want to keep a note of it. Non-participatory liquidation preference. What is anti-dilution? It's the right not to get diluted. It's the right that if your business is pegged higher, if you raise money at 100 crores and then the next round happens at 80, your shares are entitled to an adjustment through a formula which is called the anti-dilution formula. Okay? It doesn't mean that the next time you raise money, you have to give your investor more shares. It only plays out if there is a round which is below the price at which the investor came. This right also is given to all investors typically because it is linked to the instrument. So you don't negotiate. Okay. I think we have already kind of covered the main things. I don't want to overcomplicate today's conversation by going into clauses which will not play out for you easily. Maybe I'll take a few questions because I think the basics we have done. Let me take a few questions from the group in case you have something out of what we spoke today. If you can keep in mind what we discussed today, you are 60 to 80% there on understanding what a term sheet is, right? And what the key metrics, etc. is, right? And what is the reason of having these rights and who should you give these rights to. So if anybody has any question, we can take a couple of questions and close out the session.
Ma'am, I have a doubt. Ma'am, one of our founders, if he likes to invest in our company, he's a founder also or also a co-founder, he's also like to invest, and this term sheet, is it applicable for him also?
You're saying if a founder wants to invest in his business, is the term sheet relevant for him? No. If a co-founder wants to invest in the business, you may have terms of investment, but typically you will not land up giving the co-founder the rights of an investor, right? So our entire conversation today was about investors and what rights to give them. A co-founder investing is a common thing. It's not like it doesn't happen, but they will still get equity shares. They will not get all these rights. They have to play the role of having obligations on them, right? So a co-founder investing in a business will not attract a term sheet the way I have explained to you today.
Okay, what if, how much is an ideal amount of shares which should an investor have before, like, when we want to raise
That's a very simple answer. You should have, 10,000 shares of 10 rupees each.
Actually, before the Series A, when we want to raise, how much shares should the promoters hold, ideally?
Okay. Yeah, sure. So basically, see, when you raise funds, promoter shareholding becomes a very relevant topic, right? So you should try to hold 50-60% shares at least till that stage. I'm assuming 10% for ESOP, 15 to 20% for your next investor, right? Maybe 10 to 15% for your following investor. So if you are in the bracket of upwards of 50%, you are in a decent place.
So I want to ask one thing. A company registered under OPC, 1% company.
You can't raise investments. You can't raise.
I can't raise investment. So any, they are asking for business support investment or like something. So what kind of agreement we have to do? Any kind
so
of
you
agreement?
will have to do, see, depending on the kind of investment it is, if it's a grant, it's different. If it's an equity investment, it will be different. But the things that all of you should know is you need to form a private limited company to do a startup. That's the only structure in which all startups are structured in the country. They are not nobody should form an LLP, nobody should form an OPC from a purposes of running a startup where there will be external capital. If you're not looking to raise money from angels, VCs, then it's absolutely fine to have any kind of structure. Yeah. Can you give the mic? We'll just take the last question from sir.
Suppose my company is a private limited company. So while forming the company, I am the founder. So my share is just 40%. Then I have 4 partners, and each one is taking 20, 20, and 20. Then is somebody when somebody investing in my company, well, is it safe for me?
No. I think it's not the same for you, because when I say founder should be more than 50, I mean founders.
Yeah.
So you are currently 100%, so it's all good. Okay, they don't care. See, the way the investor will look at it is founders plus ESOP should be a minimum percentage. The distinction is more to say people who will actively participate in building the business, whether it is an employee or a founder, should hold substantial stake in the business. It's not for one founder. Okay. Thanks so much, guys. I think we have one more question. We'll take that before we close.
Suppose if I raised some small investment, let's say I diluted 5% or 10%. So without further investment, my revenue is very high. Means the 5% guy.
You're a profitable
Yeah,
percentage.
profitable.
Yeah.
The investor has a 10x or 20x return.
Yeah.
In that case, is there any provision to
Buy back the investor?
Yeah, like that.
Yeah.
Or else it will automatically get diluted if a certain revenue is reached.
You'll have to negotiate that. So if you had not negotiated this earlier, then you will have to speak to the investor and negotiate a deal and offer a sale price. But the way to do it, if you had known this before, would have been to have something built in for buyback of investor shares. See, if you're not headed in the path of continuously raising capital one after the other, then you need to, even the investor may want to exit. So you'll have to negotiate a deal here on what you want to do, and then you can either get another party to buy it, you can do a company buyback, right? But diluting the investor shares doesn't necessarily mean that there is dilution of value also, right? Because if you infuse more capital at a certain valuation, his value of those number of shares may go up also. Yeah. Typically, people will use something as dilution if they have the right to do that. In cases where, things have gone bitter, where they're trying to dilute the investor. But if the investor has negotiated good rights, if he has rights on issuances of your company, you won't be able to do that as well. Okay? Okay, thanks guys. Thanks for the class, and thanks so much for playing patient here. I'm very, very excited to see the amount of entrepreneurs we've seen here in the last 2 days. Wish all of you lots of luck. And I will request Kerala Mission to send you this, slide. Keep it in mind. I think you all, by the end of this session, if you paid attention, you will know the basics of a term sheet, right? So that's good. Okay, have a great evening. Bye. Thank you.